This might come as a shock to you, but big companies are getting bigger. Rich people are getting richer, and vital resources like housing, business equity, food, and even water are now owned by a smaller share of people than ever before. Groundbreaking journalism, I know. But what most people don't realize is just how concentrated this has really become. Private equity now controls as much as 20% of the entire US economy. Top index funds now own 20 to 30% of all major companies listed in America, and even good old-fashioned fraud is getting bigger and more concentrated. And who can blame them? Economies of scale have encouraged businesses to scale markets, responded to too big to fail by becoming too big to fail. But what does this actually mean for regular people? There is the moral argument that so many resources being controlled by such a small few is, unfair. But let's be honest, you've already made up your mind on that, and no YouTube video is going to change it one way or the other. Instead, what actually matters here is how much further this can go, and what happens to markets when these people have nobody left to sell to but themselves.
The last quarter, you were able to buy, looks like a little bit more than 1,500 homes for $656 million.
These investment companies, they want to make money. That's what they're there for.
Outrageous is your tax dollars are helping Wall Street buy up single-family homes. You're subsidizing Wall Street.
Water Asset Management is a Wall Street investment firm with offices inside this building in New York City.
That as water becomes scarce, Wall Street sees profits.
Elon Musk, the world's richest person, is now the first person to have a net worth surpassing $400 billion.
Private equity has become the boogeyman of finance, just like hedge funds were in the 2010s, and sometimes for a good reason. Average people have been told to hate them. Insufferable Wharton grads want to intern with them, and the industry is making more billionaires than oil, real estate, and even technology. The question is, are they creating value or just extracting it? These alternative investments used to be exactly that, alternatives. But the private equity market has changed in just the last 15 years from a small niche that was popular with a select few families to one of the biggest asset holders in the world. Because private equity is private, it can be hard to accurately estimate just how much capital is controlled by these firms. But a report published by the management consulting firm McKinsey & Company estimated that it was over $13 trillion as of June of last year. Given general market conditions and fundraising, it's likely to be even higher now. Now, there is nothing actually that special about private equity. It really just means any investment made into a business or security that is not listed on public markets. So if you invest $1,000 in your brother's farmer's market stall, you are technically a private equity investor. So, make sure to slap it on the LinkedIn profile. So the reason that private equity got so big so quickly has nothing to do with it being an amazing investment or anything silly like that. It's purely the result of a financial system that has become too concentrated. The American economy, finance, and business activity are all much bigger than they were in the 1990s, but the number of publicly listed companies has actually gone way down since then. In fact, it's almost halved in the same time the economy has tripled in size. Now, one big reason for there being less publicly listed companies is simply because bigger companies have been acquiring smaller companies at record rates, making for a more concentrated business environment with fewer companies overall, which is, the whole point of this video. But we will actually get to the consolidation later. There are also fewer companies IPOing in the first place, because there really is no need to anymore. Companies list themselves on stock exchanges to raise money from the public, hence why it's called an initial public offering. But the general public just doesn't have that much money anymore. The wealthiest 10% of Americans now own 93% of all publicly listed stocks. The vast majority of capital flowing into public stock markets comes from people or institutions that are rich enough to invest in private equity, so the regulatory and reporting burden of being a public company just simply isn't worth it to get access to 90% of people who all collectively own just 7% of the market. That 93% of stock ownership is largely held through retirement accounts, which are handled by funds which can invest into private equity as well. So for most companies, it just doesn't make sense to go public anymore. Now, alright, so what? People have slightly fewer options to ape their life savings into on Robinhood. Well, apart from that, this trend, which has only really been going on for 15 years at this point, is really causing a lot of problems and costing you a lot more than you realize. The first issue that doesn't get nearly enough attention is how they have created micro-monopolies. When you think of monopolies, you are probably going to think of giant companies that own entire markets everywhere across the world, like, YouTube. But a much more common type of monopoly has started to become a bigger problem. These are small, local monopolies. One of the hottest new private equity investments has become youth sports leagues. Little League is a great investment because firms can buy up all the sports in a local area and create a monopoly on competitive team activities. And nobody wants to be the parent that denies their child the opportunity to go and touch grass with their friends. According to a report by the Aspen Institute, these local leagues are collectively a $30 billion industry, and they are becoming more expensive as they are consolidated by private equity firms. Now, this is just one particularly scummy example, but creating local monopolies is just a good business strategy. It's not technically legal, but the Federal Trade Commission just doesn't have the manpower to identify and enforce these thousands of local issues when they don't even really have the resources to go after the most obvious monopolies. These subtle consolidations have changed how and where we spend our money, but it has had a much more serious impact on how we earn our money. So it's time to learn how money works to find out if it's possible to reverse the concentration of everything. This week's video is sponsored by Odoo. Odoo is your one-stop software solution for small and medium businesses, offering a full suite of integrated apps to streamline operations, everything from CRM and sales to inventory and accounting. Today, we're shining light on Odoo's website builder. It's a tool that we've been testing for an upcoming project. It lets you create sleek, professional websites with zero technical know-how required. Best of all, it's completely free. That includes unlimited hosting, support, and even a custom domain for 1 year. No strings attached. Our experience with Odoo has been fantastic. The intuitive drag-and-drop design makes building a website straightforward and enjoyable. Plus, the built-in ChatGPT integration has made it a breeze to craft and refine our content. Whether you're starting fresh or giving your current website a facelift, Odoo's website builder makes the process stress-free and fun. Ready to start? Head over to odoo.com/r/T48 to build your brand online with ease. Another major problem with a lot of businesses being owned by a very small group of investment firms is that it makes it really hard to see what is actually happening in our own economy. Public companies have to release regular financial statements, and their market value is updated every microsecond as their stock is traded. As more of the market is held by a smaller group of investment firms, it gets harder to tell how these businesses are performing and how they are being run. John Coates, a professor of law and economics at Harvard, recently released a book called The Problem of 12, When a Few Financial Institutions Control Everything, which addressed exactly this problem. Specifically, he mentions that pension funds have found private equity very attractive, and since most pension funds are investing on behalf of regular people, it can be very difficult for those people to see how their money is being used since there are two financial institutions between them and the business they are actually investing in. Coates also speaks about the concentration of capital in index funds like Vanguard, BlackRock, and State Street. He doesn't highlight the usual criticism like Larry Fink being a lizard man that secretly controls the global economy, but he does raise the issue that the way these financial products invest money makes normal price discovery much harder and also incentivizes getting more concentrated. Something like Vanguard's VOO ETF just mindlessly takes investor money and puts it directly into the weighted average of the 505 stocks that make up the S&P 500. And yes, there are actually 505 stocks in the S&P 500 because some companies list Class A and B shares. Finance bros aren't very good at naming things. This means that a large share of investors are just investing in whatever has the most investors, which has just helped contribute to immense valuations of companies at the top of the market. The amount of investment capital concentrated through these investment managers means that they now have significant influence over company shareholder votes, and new products like ESG or green ETFs can have more influence over board decisions than they really should have. There will be a link in the description below to that book if you are interested in reading the whole thing, though you should know it was written for MBA students at Harvard, so it is a little bit dense. He also gave a half-hour interview just last month available here on YouTube, which is also worth checking out. Another big problem is corporate debt. Most of the biggest private equity firms in the world use what's called a leveraged buyout. This is where they will buy a whole lot of companies, get those companies to take out big loans, and then use the borrowed money to pay themselves back so that they can go and buy even more companies. This normally involves a lot of cost cutting in the business so they can make their repayments. But on a wider scale, it's contributed to the record levels of corporate debt that we have in America today, which, as a percent of GDP, was only higher during the first wave of PPP loans, and just after the global financial crisis. Businesses always want to get more concentrated. It's the natural order that big businesses will acquire little businesses or put them out of work. The rise of private equity, the proliferation of passive index funds, low interest rates, and the flaccid approach of regulators has only made this natural process much faster. But this still isn't the worst part. Corporate concentration has made finding competitive job opportunities extremely difficult, especially for people in smaller communities that have had local businesses quietly rolled up by large investment funds. The best way to get a higher salary as a worker is to switch jobs for better opportunities. But if you are a plumber and all of the plumbing businesses in the local area are owned by the same holding company, you aren't going to be able to negotiate like you would with competing businesses. Now, if you think you could get around this problem by starting a business of your own, well, actually it gets even worse. In an article published by the Washington Post, Lillian Salerno, a healthcare entrepreneur, spoke about her difficulty in bringing a new, safer medical syringe to the market because businesses up and down the supply chain had become highly consolidated, so they didn't want to work with a potential competitor even if her product would have been better for patients. This is technically anti-competitive practice, but again, regulators are understaffed and underfunded. It's even worse in highly scalable industries like technology. The most important thing that early-stage investors now look for in startup companies is an exit strategy, which is just business speak for who is going to buy this company if it's successful. Those buyers are either a few of the industry top players or a private equity firm. The result of this is that only companies with the highest potential to scale and the best opportunity for acquisition actually get funded, which is why places like Silicon Valley have gone from making technology to solve the world's problems to writing algorithms to keep you watching your phone for an extra 20 seconds a day. A blog post written by Ross Bears, who is ironically the president of a venture capital firm, called this the stagnant pool of American entrepreneurship. If you wanted to start a company tomorrow, you probably wouldn't know where to start, especially if you had to go and raise capital from professional investors. There are programs like Y Combinator that incubate early-stage companies, but access to these programs is highly competitive. The people that have the connections and experience to get these businesses started also know that the best way to run these businesses is to just build it so a bigger business comes along and buys it. The people that have felt this the worst are the tech bros. An entire generation of people were told that if they just learned to code, they would have a stable career for life. Go and watch my video on the rise and fall to find out how instead it just turned into a giant casino where workers either get life-changing payouts or they're just part of record layoffs. And make sure to subscribe to keep on learning how money works.